Berkshire Hathaway company reported their Q2 earnings today. We'll get into them. We'll take a look at the stock buybacks. We'll take a look at some of the acquisitions or the major buys that Warren Buffett has done more recently. We'll take some comfort in knowing that the Oracle of Omaha is down big time in his investments over the first 2 quarters of this year. So we'll look at that. We'll take a look at the companies that he is concentrating in. There's all this investment advice out there that tells you, hey, you need to diversify and you really need to spread out your portfolio. Well, Warren Buffett's got 69% of his money in just 5 stocks. So we'll discuss maybe if concentrating your investments might be a good idea. Take a look at the balance sheet over at Berkshire Hathaway. We'll take a look at the revenues, the profits. Obviously, this stock is extremely unique. You get wholly owned assets like Geico, you get the railroads, you get a utility business, you get manufacturing and even some retailing like Dairy Queen. But then obviously you own pieces and large chunks of other companies. And on top of that, they're buying back the shares and acquiring new companies. Very unique company. So we'll take a look at some of the revenues over at this company. We'll look at the cash flows. We'll look at that compared to last year. And then finally, we'll come over here and look at it from a technical perspective. We did not change our green zones from the last time we did analysis on this company. I tell you what, this one is at a tipping point, and if it breaks lower, I think you're going to know what you need to do. Now, over the last year, this one's down 2.9%. Over the last year, just up 4.2%. But when you look at the performance of the markets, this one's certainly outperforming over the last 5 years. Paints a beautiful story, up 65%. You start stretching this out even longer time frame, you see just the consistent returns. We'll certainly see evidence of that when we look at this company's performance. Now, the company in the most recent quarter did about $1 billion worth of common stock buyback. That's a deceleration over the previous 2 quarters. And in fact, we'll see that for the most part, Warren Buffett's kind of taken his foot off the gas in terms of the buybacks and the equity buys. But one thing that he's full blown on is that is getting a big old equity stake in public company Occidental Petroleum Corporation, otherwise known as OXY. Recently, Warren Buffett has been buying this stock hand over fist. He's built up nearly a 19% stake in the company, and a lot of analysts project that Warren Buffett will buy this company in totality at some point down the road. Now, in terms of the performance over at Berkshire, look, insurance looking pretty good, railroads looking steady, all of their normal business lines over at Berkshire looking very steady from a year-over-year perspective. Now, what's not steady is that market turmoil, and you see in the most recent quarter on paper gains, or in this case's losses, that Berkshire had to recognize over $53 billion worth of losses. So I tell you what, if you're looking at your portfolio and it is down, well, guess what? Warren Buffett's portfolio is down too. But when we come over and look at the value of the stocks that he owns, particularly the top 5 holdings that represent nearly 69% of his in total portfolio, American Express, Apple, Bank of America, Coca-Cola, and Chevron make up over 70% of this portfolio, which has a current value today at over $327 billion. You might ask yourself, what did he pay for that? He paid just $149 billion for these assets. That's an unrealized gain of over $177 billion. So you've got just in the equity stakes that this company has made over the past couple of years, they've booked an unrealized gain, a paper gain, if you will, of $177 billion to give a total value plus the cost basis at $327 billion. And you have a $645 billion valuation, meaning essentially half of the valuation is tied up into these equity stakes in other public companies. And we certainly can learn from this, considering he concentrates a large percentage of the company's portfolio in a small number of stocks, and then he holds them over a long period of time. And that, my friends, I think is a great example of how to grow wealth over the long term. Just make sure you're picking the cream of the crop to include in your 69% and not the Teledocs, the Zoom videos, the blocks, and the PayPals. Those go, my friends, in your speculative portfolio. Now, moving on to the balance sheet, we see over the first 6 months of the year, pretty healthy depletion of assets, most of that coming from cash. We'll show you some of the things that this company used that on. Everything else from a balance sheet perspective, about where you'd expect this company to be. Now, in terms of those revenues, some interesting things that we've got to talk about here. So we have the insurance business. Total revenue for the insurance business coming in at $63 billion. That was up from the previous year on a quarterly basis of about $57 billion. Now we have that railroad business as well. Very steady business. You had $13.1 billion worth of revenue this year, 11.8 last year. So our total revenues in those wholly owned, 100% owned businesses went from $69 billion up to about $76 billion, or roughly 10% growth year over year just on those 100% owned business. Now, where this company had to take a massive hit is on paper, their investment and derivative contract gains have to be reported as a $66.9 billion loss. That's certainly going to whack off a ton of this total revenue. But we'll put those losses aside, since most of those are going to be paper losses and not actual realized losses. We'll look at our costs and expenses inside insurance. Our total costs coming in at $54.5 billion. So you take this $63 billion and you minus off about $55 billion, and you get your total income from that business. And then finally, railroads expenses coming in at $10.4 billion. Again, we had $13.1 billion worth of revenue. And so you've got another profitable business as well. So your total costs and expenses coming in at $65 billion. You minus off this 76, you're getting right around kind of $11 billion worth of operating profit off of the wholly owned business. You look at last year, you were probably close to about $8 billion. So a steady growth on that revenue side, just keeping up with kind of the 8 to 9 inflation that we're seeing out there. And same thing on the earnings side, just nice steady growth, nothing spectacular. When you pull down to a net income number, it looks disastrous again, because they have to recognize these really, really steep losses that the market saw through the first 6 months of 2022. Now we get to add that back in when we come over here to cash flows, because again, that is not cash. Those unrealized paper losses that you and I are also seeing in our portfolios as well, certainly the longer term ones. So we pull down net earnings of negative $37 billion. Last year, you were positive, mainly due to the fact that you actually recognized over $32 billion worth of investment gains last year. That swung to a loss of $68 billion. So if you're looking and you're seeing red in your portfolio, don't worry. The greatest investments in the world are seeing the exact same thing. On a cash flow statement, we get to add that back in. We get to flow down to our net cash provided by these operating activities, down from $19 billion to just $15.3 billion. So a shrinking of cash flows, even when factoring in those investment gains and losses. Certainly nothing I'm particularly alarmed about when you go through this company. Very financially healthy. Now, some of you might be wondering, did Warren Buffett really step in there and buy the dip on some of his core holdings? He's certainly doing it from a press release perspective. We're seeing Occidental Petroleum headlines come up on a regular basis. So he is doing some buying. But when you come over here to cash flows, you see for the first 6 months, we've got our purchase of equity securities. This is your Oxys, your Bank of Americas, your Apples. You see for the first 6 months, we spent $57 billion. That compares to just $3.59 billion in the previous period. I tell you what, Warren Buffett was very savvy in realizing that the valuations in 2021 were very expensive. He did not do a lot of buying. And the minute they fell off a cliff, he unloaded a clip and bought $57 billion worth of stock during the first 6 months of 2022. Now, here's the thing though. In Q1, he bought $51 billion of this $57 billion. So really, over the past couple of months, Warren Buffett really hasn't been buying the dip. Okay, you see evidence of that when they are only buying back about $1 billion of their own stock. They bought back far more in Q1 of $3.2 billion. This is Berkshire stock, and over $6.9 billion back in Q4. So they've slowed the pace of that. And then you also see that they bought back far more stock in Q1 at $51 billion than they did in Q2. Again, this is not necessarily to say Buffett is the perfect timer of stocks. I think even if you read his commentary and listen to some of the things he says, hey, we're usually not the best at timing the market. I just thought I would point that out, that the fact that they absolutely slowed their buyback and slowed their equity purchases into Q2. We'll certainly be looking forward to Q3 and Q4 to see if he reaccelerates that. Now, some of the reasons why he might have slowed is, look, his stock was down here at about 267, and like a lot of stocks, has been on a rocket ship. This one's up here at about $289 per share. Interestingly enough, it's sitting between two sideways consolidation zones that we've identified it here on the channel. It hit its head right on the top where you'd expect some resistance to be, right at the bottom of this upper green zone, right at about $300 per share, and got rejected almost perfectly to the penny to the top of this zone. That's how we know these zones are very firm. I think if you get a further breakdown in Berkshire stock, I think that would also require a further breakdown in the S&P 500 and the Dow Jones and broadly the stock market. If you already own this stock, you want to continue to add this, or if you want to start a position, I would do it about halfway down this zone, which would take you right at about $280 per share is where I like kind of starting any kind of buy or maybe adding to. Now, the other scenario is this upper trend line that this stock and a lot of stocks that are making, well, there's a possibility that it just continues and you rocket up higher here with Berkshire. I tell you what, if you can push up into the 305, 306 range on this one, now you're towards the bottom end of this zone, and it would make a little bit of sense to buy it here, hoping that this momentum continues to push this up. For me, that would be maybe more of a shorter term trade, because I still feel, first of all, the longer term trend since the beginning of the year on this stock and most stocks is still down. Even like intermediate trends where you're looking at maybe over the last 90 days or so, technically down as well. Looking back a couple of weeks from now, I think we'll view this maybe as another topping pattern. We pull back, retest these lows that we made just about a month ago. That again, I think is your buying opportunity. But quite frankly, a lot of investors are going to have that attitude as well. That's why I probably would start buying a little bit before it got all the way to the bottom of the zone. Again, this applies for Berkshire, but this applies to other stocks that you're looking at. I probably would get in there a little bit sooner than wait for that perfect technical pullback that a lot of us are starting to wait for. Everybody's viewing the charts the same. A lot of people's attitudes are starting to shift as well. So I would be a little bit earlier this time around. Hopefully you guys enjoyed today's video. I'll be back again soon with more. Good luck with your investments.